How much is gold really worth? The answer we get depends on who we ask and what their opinion is. Everyone has an opinion as to what something is worth, whether the object of consideration is their home, a late grandfather's pocket watch, or a specific stock. In that respect, gold is no different. The price of a specific item or asset at any given time is a reflection of all those varying opinions. Some are based on fundamentals, some are based on technical factors. But the combination of all the opinions, and the resulting expectations, some expect the price to go up, others expect it to go down or remain the same, plus all of the other known factors at the time that might possibly impact the price, provide us with the clearest possible indication of current value for the item in question, its market price. If we believe that gold is money, then we likely will have a different opinion or expectation than someone who sees gold as an investment, or someone else who deems gold to have no useful value. If we don't believe that gold is money, then we are saying that something else is. That something else, practically speaking, is fiat, paper currency issued by a government or central bank, dollars, euros, yen, etc. With that in mind, let's rephrase our original question. In other words, how much is money worth? In the simplest of terms, money is worth whatever it can be exchanged for. The value of money is in its purchasing power. With that fundamental understood, then the logic is reasonably simple. Gold, or any other money, is worth what we can buy with it. So, what can we buy with it? And how do we know that the value of our gold, money, is realistically priced? With gold currently priced at $1,240 per ounce, the value of gold today is what we can buy with $1,240. But is $1,240 per ounce today realistic? Or rather, are there reasons why we might expect the price to rise or decline to any substantial degree that would influence our choice to hold money in gold vs. US dollars? In order to answer that question, we need to do some research. And, in order to diffuse any arguments about whether or not gold is money, and to set aside, as much as possible, any biases, let's go back to a time when the US dollar and gold were both money and equal in value. In 1913, both gold and US dollars were legal tender, and interchangeable. Either was convertible into the other at a fixed price. A 1 ounce (0.97 ounces) gold coin was equal to $20 and vice versa. Note, the official gold price was $20.67 per ounce, which multiplied by 0.97 ounce of gold in a gold coin equals $20. On the surface, it would seem that 1 ounce of gold over the past 104 years has increased in value by 5,900%, $20.67 in 1913 vs $1,240 today. By extension, that would mean that we can buy 60 times as much with 1 ounce of gold today as we could in 1913. Not so. We said earlier that the value of money is what we can buy with it, or we can acquire in exchange for it, but what should be obvious by now is that even though the price of gold increased by 5,900%, we don't know whether there was an increase in actual value, or possibly a decrease if gold was unable to maintain its original purchasing power. We can still, however, draw some conclusions about relative performance. The specifics are that gold gained in value by 5,900% relative to the US dollar. The corollary is that the US dollar declined by more than 98% relative to gold. Now we need to know how both gold and the US dollar fared in absolute terms regarding purchasing power. And the results are clear. Gold has maintained its value, and even increased its purchasing power in absolute terms, over the century-long period under consideration. Also, the results corroborate the current market price for gold of $1,240 per ounce. What we don't know is the extent to which the current price of $1,240 per ounce reflects accurately the effects of policies which have led to our current situation. More specifically, exactly how much value has the US dollar lost since 1913? Is it 98%, or less, 99, or more? The current market price for gold of $1,240 per ounce indicates a fairly specific loss of 98.25%. A 98% decline in the value of the US dollar translates to a gold price of approximately $1,000 per ounce. And if the decline is closer to 99%, then the gold price should be closer to $2,000 per ounce. In August 2011, gold traded at about $1,900 per ounce. That would indicate a decline in value of the US dollar of closer to 99% since 1913. But nearly 4.5 years later, in January 2016, gold traded as low as $1,040 per ounce. That price indicates a decline in US dollar value closer to 98%. In fact, it is nearly exactly equivalent to that mark. A 98% decline in US dollar value equates to a 50-fold increase in the gold price since 1913. 100% minus 98% equals 2%. 100% divided by 2% equals 50. $20.67 per ounce times 50 equals $1,033.50 per ounce. Between 1999 and 2011, gold increased in price from $275 per ounce to $1,900 per ounce. And during that same period, the US dollar declined in value by a commensurate amount. Between August 2011 and January 2016, the US dollar was in a clearly defined uptrend. And that uptrend was mirrored by a similar percentage decline in gold. Since January 2016, both gold and the US dollar reversed direction for about 6 to 9 months and then stabilized, generally, at levels close to where they are now. Conclusions. Gold, in US dollars, is worth somewhere between $1,000 and $2,000 per ounce. Furthermore, and to be more specific, the current price of $1,240 per ounce is a reasonably accurate reflection of gold's current worth. Any consequential variance exceeding $1,100 per ounce on the downside and $1,300 per ounce on the upside will be accompanied by similar, inverse changes in the value of the US dollar. The US dollar is the only barometer you need to watch. The elements of surprise and timing are critical. Most especially so, if you are short-term oriented in your thinking. Items for consideration that could have a substantial impact on the US dollar include 1. New and unexpected actions by the Federal Reserve. 2. A clearer picture of the enormity of the Fed's balance sheet. 3. Accelerated, delayed effects of inflation previously created by the Fed. 4. A credit implosion. 5. The Fed's reaction to a credit implosion. Some of the listed items, or variations of them, can affect the value of the US dollar positively, too. Which is why you need to keep your eye on the dollar, and not the specific event. Kelsey Williams is a retired financial professional living in southern Utah. His website, Kelsey's Gold Facts, http://www.kelseywilliamsgold.com, contains self-authored articles written for the purpose of informing and educating others about gold within an historical context. In addition to gold, Kelsey writes about inflation, interest rates, and the Federal Reserve Bank. His articles have been published on several international websites.